You are listening to The Vocal Technologist. Spoken Tech for your ears.
Welcome back, everyone. It is quite an electrifying time in the world of digital assets, isn't it?
It really is.
I mean, you've seen the headlines. Bitcoin blasting past $111,000, getting seriously close to its all-time high.
Mm-hmm.
And Ethereum is not far behind, jumping, what, 6%? Up to $2,760.
That's right. Quite a surge.
So the big question is, what is really going on here? What's fueling this? And, what does it mean beyond just watching the ticker?
Yeah, it's definitely a dynamic period. That Bitcoin move, for instance, it actually caused something like $425 million in short positions to be liquidated.
Wow, $425 million.
Yeah, basically, folks betting against the price got squeezed out. And that kind of event, it's not just a number, it really signals strong conviction in the market, sort of deeper shift, perhaps.
Okay.
So while those big crises grab the headlines, like you said, the real story might be these foundational shifts, institutions getting more involved, things happening, under the surface.
Right. Okay. So let's try and unpack some of that today. Our mission really is to cut through all the noise and pull out some of the most fascinating, maybe even surprising developments we're seeing.
Sounds good.
We've got everything from major banks partnering up, blurring those lines between traditional finance and crypto, to some really audacious new platforms popping up. And yeah, even this concept someone's calling the DeFi Mullet.
Yes, that one.
So the aim here is just to arm you with the key insights, the stuff you actually need to know to be properly informed about where things might be heading.
Let's do it.
So this shift, it feels different somehow. You mentioned before we started recording how sometimes declining volatility comes before big moves up.
Yeah.
Is that playing out here? Or is it still just, retail FOMO driving things?
That's a really good question. And analysts have pointed that out historically. Periods of lower volatility have often preceded these significant rallies. But zooming out, what seems different now is the sustained institutional interest, especially around Ethereum, is becoming increasingly important for things like tokenization and as this broader settlement infrastructure.
Okay.
So, it suggests maybe a more mature market this time, less purely driven by retail speculation.
Okay, and speaking of institutions, get this. Ripple just announced BNY Mellon as the main custodian for its RLUSD reserves.
Oh, wow. BNY Mellon.
Yeah. RLUSD is their stablecoin, right? So the one aimed at enterprise cross-border payments.
That is a very significant development. BNY Mellon isn't just holding the reserves, they're also providing Ripple with transaction banking services.
Right.
So it shows this real deepening of ties between, a traditional finance giant and regulated digital asset infrastructure. It really underlines Ripple's push for institutional stablecoin use.
It just shows how intertwined these worlds are getting, doesn't it? The lines are definitely blurring.
Completely. Used to be very separate worlds, not so much anymore.
So beyond the big established players like Ripple, we're also seeing some pretty wild new ideas emerge, like Blueprint. They're partnering with Privy.
Yes, the AI agents.
Exactly. Launching AI agents to actually manage assets across different chains. EVM, Solana, Sui.
Which is a big deal for interoperability. Having AI just, move and manage your stuff seamlessly across networks, that's quite a leap.
Huge leap for automation, too.
That automation is definitely key. But, on the other maybe more speculative side, you've got projects like Pump.fun.
The meme coin platform.
Right. They launched their own token with an ICO talking about killing Facebook with some kind of social streaming platform.
Very audacious plans.
Extremely. They sold a massive token supply, but then you see something like Bonk just flipped Pump.fun recently, dominating the meme market share again,
So is it real innovation or just, hype and chasing quick attention? That's the constant question, isn't it?
It really is, discerning the signal from the noise.
Yeah. But okay, let's zoom out a bit from individual projects.
Right.
What about the money, the venture capital flowing into the space? What did that tell us?
Well, crypto VC is definitely in a, let's say, challenging spot right now. Returns to investors have been lower, which naturally makes fundraising harder.
Yeah.
But interestingly, even though the number of deals might be slower, the actual amount of capital being deployed is kind of on pace with last year.
Oh, really?
Yeah. And M&A activity, mergers and acquisitions seems to be picking up. That suggests better exit opportunities for VCs, which is, vital for the whole ecosystem's health.
Right, need those exits.
So for us, looking at it, it suggests the market is maturing. It's building more sort of sustainable pathways for innovation, not just relying on that early stage hype.
So maturing markets, capital shifting. This actually brings us to a really interesting psychological idea someone flagged, the sunk cost cage.
Ah, yes.
This idea that, past investments, time, effort can kind of trap you, keep you stuck in something even when it's not really working anymore.
It's a powerful bias, absolutely. And while, yeah, individuals can get caught, you look at the bigger picture, you see, $49 billion flowing into Bitcoin ETFs?
Huge numbers.
$4.3 billion into the Ether ETFs. Robinhood launching its own EVM chain on Arbitrum, offering perpetual swaps those long-term trading contracts.
Right.
These moves clearly show crypto evolving, becoming part of mainstream finance. So escaping that sunk cost page means being really honest, right? Admitting maybe past efforts aren't the future and embracing these broader opportunities. It's a lesson for everyone in this space, not just institutions.
Embracing broader opportunities. That leads perfectly into this DeFi Mullet idea you mentioned earlier, and I love this term.
That's brilliant.
Fintech apps in the front, all sleek and user-friendly, but powered by Ethereum DeFi infrastructure in the back. What's the big deal there? Why is that significant?
It's significant because it potentially offers the best of both worlds. Users get that smooth interface they expect from, modern apps.
It's a normal banking app.
Exactly. But underneath, they get the benefits of permissionless finance open systems, no intermediaries needed, more transparency. Ethereum allows for faster integrations. You get real-time transparency on-chain, immutable infrastructure.
Tamper-proof.
Right, building financial products without all the legacy baggage. And we're seeing proof points like Coinbase's crypto-backed loans using Morpho. They've got like $860 million in collateral there.
Wow.
So as these open finance stacks get more robust, yeah, the thinking is the next wave of consumer apps will have Ethereum humming away under the hood. It's like a stealth innovation.
Stealth innovation, I like that. So, okay, wrapping things up. We've touched on market maturation, some really groundbreaking tech, even the psychology of the space. Understanding all these layers feels crucial to figuring out where finance is actually going.
Absolutely. The pace of change is it's breakneck. It demands constant learning, adaptation, critical thinking. What feels really niche or experimental today could genuinely be mainstream tomorrow.
Spoken Tech for your ears.